In this lecture, we will cover the CFA Level 2 reading on the portfolio management process and the investment policy statement. This is a short reading and it actually has several relatively short sections. Many of these sections are not mentioned in the learning objectives. So I'll just tell you a few words about what's in every section and which section I'll cover and which I will not. So the introduction is just a high-level statement on what is being covered in the reading. Then section 2 talks about the investment management industry, its size, how it evolved, and so on. Since none of the learning objectives are tied to this section, I will not cover it. If you have time and interest, you can read it. Then there is a very short section on the portfolio perspective, which is a learning objective, so I will cover that. Then section 4 is a very brief section on portfolio management as a process. Essentially, this is saying that portfolio management is a process which consists of activities that are interrelated. I'll not cover this because the entire section 4 is actually addressed in section 5, where the process is given and also the logic and the justification of the process is explained. So a lot of our lecture will focus on section 5. And then section 6 is also very important. This talks about the investment objectives and constraints which form the meat of the IPS. So the most important aspect of the IPS is the investment constraints and objectives. Then section 7 is the dynamics of the process. This section is not mentioned in the learning objectives, but I'll tell you very briefly what is given here. Essentially, the portfolio management role is glorified. And how is it glorified in this section? What is being said here is that the portfolio manager is at the heart of this whole process. Why? Because what does a portfolio manager do? The portfolio manager needs to interact with the clients. The portfolio manager interacts with the economists in a given institution or external economists. He interacts with investment managers or investment analysts. And the portfolio manager puts together all this information related to the client and related to information coming from the economists and the investment analysts and so on, and then decides what's suitable for the client, obviously in consultation with the client. And then the portfolio manager also needs to coordinate with the trading desk to make the transactions happen. So the way the curriculum puts it is, what economists do is theory, and they're saying this is where the world is heading, this is what we should do. Investment analysts are suggesting what's good, what's not good, which stocks are underpriced, what assets are overpriced, and so on. The actual action, making it all happen, is done by the portfolio manager. Right, so that is a summary of section 7, but again, it's not mentioned in the learning objectives. Section 8 is also not mentioned in the learning objectives. This deals with the future of portfolio management, and the brief summary of this section is that the future is bright, and obviously that is what the CFA Institute will say. And then section 9 deals with the ethical responsibilities of portfolio management, which is the last learning objective in this reading, and we will cover it. Okay, let's start with the portfolio perspective. Now, you've heard this over and over and over, but since it is mentioned here, I will also emphasize the point. Individual investments should be judged in the context of how much risk they add to a portfolio rather than on how risky they are on a standalone basis. So a picture that I've drawn before is as follows. Let's say this is your portfolio, and this is a particular asset that you are evaluating. The asset has a return and it has a risk indicated by its standard deviation. Let's say that the risk is high, the return is moderate. Can you just accept or reject A based on this information? The answer is no. You need to consider what happens to your portfolio if A were added to the portfolio. And that is what we mean by a portfolio perspective. A classic example of using the portfolio perspective is with an investment such as gold. If you evaluate gold on a standalone basis, you might not buy, because just looking at the Sharpe ratio of gold will be extremely low. But if you think about the fact that the value of gold is not correlated with the stock returns, then adding gold to your portfolio might actually give you a substantial amount of diversification benefit. A related point is that if we evaluate the prospects of each asset in isolation and ignore the interrelationships of the assets in a portfolio, we will likely misunderstand the risk and return prospects of the investor's total investment position. In other words, it's conceivable that an investor has several risky assets, but they are all risky in different ways, and collectively the portfolio is not very risky because the risky assets balance each other out. All right, now we come to one of the most important segments in this reading, which is section 5, the portfolio management process logic. I'm going to make this high-level remark, and the process that you see here is an adaptation of what is in the curriculum. I've just tried to simplify and clarify what's in the curriculum. Portfolio management is an ongoing process in which the investment objectives and constraints are identified and specified, investment policies and strategies are developed, and the portfolio composition is decided in detail. Portfolio decisions are initiated by portfolio managers and implemented by traders. Portfolio performance is evaluated, investor and market conditions are monitored, and any necessary rebalancing is implemented. This statement summarizes what we are going to talk about. Now let's look at the process. Broadly speaking, like any other process, we have 3 stages. Planning, so these items fall in the planning stage. Then we have execution and feedback. Let's start with planning. In planning, the first thing we need to do is identify and specify an investor's objectives and constraints. And this will be covered in detail in section 6. All we'll say right now is that the output from this activity is an IPS. So the action is create an investment policy statement. But just one high-level remark I'll make here is that in creating the IPS, where among other things we define the objectives, the return objectives, the risk objectives, the constraints, but if you think about defining return objectives and risk objectives, we obviously need to consider the client, but we also need to understand how capital markets are likely to perform. So as portfolio managers, we need to have a view on capital markets. What do we expect stocks to do? What do we expect bonds to do? What do we expect other asset classes to do? And then what we define as the return objectives and the risk objectives should be in the context of capital market expectations. That's why you see the arrow in both directions, and it is taking both these into account. We need to take both the investor perspective and the market perspective into account as we create the IPS. Let's get into a little more detail with the IPS now. The investment policy statement, or IPS. The investment policy statement is a written planning document that governs all investment decisions for the clients. The IPS integrates a client's needs, preferences, and circumstances into a statement of the client's objectives and constraints. I'm not going to read this out, but I expect you to. These are the elements of a proper IPS. It includes a brief description of the client and so on. And I've highlighted 2 points which are emphasized in this reading. Clearly, the IPS needs to have a statement of investment goals, objectives, both the risk and return objectives, and any constraints that the investor might have. Also, the investment strategies and investment styles need to be defined. The objectives and constraints will be covered in section 6, but we need to say a little bit about investment strategies and style. When we talk about investment strategies, broadly speaking, An investment strategy represents a manager's approach to investment analysis and security selection. And this really is a spectrum, but three of the important strategies in that spectrum are passive, active, or semi-active. What does passive mean? In a passive strategy, the portfolio composition does not react to changes in expectations. An example is indexing, which involves a fixed portfolio designed to replicate returns on an index. All right, so we just say that we'll create a portfolio that matches the S&P 500. So that is a passive strategy. An active strategy is one that tries to beat a benchmark, holding a portfolio different from a benchmark or composition portfolio for the purpose of producing positive excess risk adjusted returns. So ideally, if you have a benchmark, you take the same level of risk as the benchmark, but try to outperform the benchmark. And then semi-active is somewhere in between. For example, you might have an indexing approach and then controlled use of weights different from the benchmark. So you can say that if a given stock has a certain weightage or a given industry has a certain weightage in the benchmark, then you are allowed to go 20% on each side of those weights. Your exposure cannot be too different from the benchmark. That's why this is a hybrid or an in-between strategy. We've talked about the IPS. I have alluded earlier to the fact that you, as a portfolio manager, need to formulate capital market expectations. We combine these two. So a view of the client's risk, return objectives, the client's constraints, and we consider the capital market expectations, which basically deals with what do we expect from the different asset classes, the risk, returns, and the correlations of the different asset classes. And based on this information, we come up with a strategic asset allocation. So what do we mean by a strategic asset allocation? A policy or strategic asset allocation establishes exposures to IPS permissible asset classes in a manner designed to satisfy the client's long-run objectives and constraints. Now, what you might say is that your client is, let's say, a wealthy individual who is working, has a high salary, and has several years to retirement. You expect stocks to continue to perform well. So given your expectations of the market and given the circumstances of the client, you might come up with a strategic asset allocation which says 90% of the money should go into stocks and 10% can go into bonds. So this is an example of a strategic asset allocation. Generally, maximum and minimum permissible asset class weights are specified as risk control mechanisms. So what this is saying is that when we specify asset allocation, what we might also say is that a 5% deviation is allowed on each side. So if we are extremely bullish on stocks, we might actually go up to 95%. If we believe that the market is overvalued and we are bearish, then we might actually come down to 85%. So very often we have these bands, and this is something that we'll see in a lot more detail at level 3. The plan reflects the interaction of objectives and constraints with long-run capital market expectations. So I've already alluded to that. When you come up with this allocation, you are thinking about the client, and you are also thinking about the expectations you have related to the capital markets. Investors may seek both single period and multi-period perspectives in the return and risk characteristics of asset allocation under consideration. So what does this mean? When we say single period, what we are saying is the following. You might say that, okay, I'm creating the portfolio here and my perspective is a 30-year period because at the end of 30 years I will retire. So here, as you create the portfolio, you are only considering one time period. This would be single time period planning. Another scenario is where you have somebody who is retiring in 5 years and they want to say, okay, over the next 5 years I'm working, so my portfolio needs to be such that maybe while I'm working, I still need some money because I'm working part-time. Maybe I'll still need some income from my portfolio. Then after I retire, then I will not work at all. So I will need a lot more income from my portfolio. So that is a simple example of a multi-period planning perspective. Coming back to our overall picture, the output over here from planning is your strategic asset allocation. So at this stage, you've done the strategic asset allocation, but you have not actually bought anything. You've not bought the underlying assets. So we move then to the execution phase where we construct the portfolio, and based on feedback, we also revise the portfolio, but let's talk about this now. What happens in execution? We integrate investment strategies with capital market expectations to select specific assets for the portfolio. This is called the portfolio selection composition decision. Note that in our strategic asset allocation, we said something like 90% stocks and 10% bonds. But which stocks should we buy? Which bonds should we buy? Which industry should we have exposure to? This is done in execution, and the process of selecting the specific stocks is right here. Select the specific assets to buy. The portfolio selection composition decision concerns portfolio construction and often uses portfolio optimization to combine assets efficiently to achieve risk and return objectives. So the point is that as you create your portfolio, you need to be concerned about the variances, the returns, the covariances, and what is the optimal weightage of your different assets. This will be done through a computer optimization program. And obviously it needs to take into account the risk and return objectives. Next, the portfolio implementation decision concerns the trading desk function of implementing portfolio decisions and involves explicit and implicit transaction costs. This material is covered in a lot of detail at level 3, but the basic idea is that once you've decided to buy, then you need to tell the trading desk to go buy. And what you want the trading desk to do is buy, but minimize overall transaction costs. And transaction costs are not just the brokerage fees, they also involve what's called implicit transaction costs, and this is material covered at the next level. Just recognize at this stage that when we buy, then we have both implicit and explicit costs. Actual asset allocation may purposefully and temporarily differ from strategic asset allocation. Now, I've already alluded to this earlier, but broadly speaking, there are two reasons why you might temporarily have an allocation that is different from the strategic asset allocation. One is related to investor circumstances, and I'll give you a silly little example. Let's say that 90-20 is your allocation and your client gets into an accident and is temporarily out of work, and we don't quite know how critical the situation is. So does it make sense to temporarily move into a more defensive portfolio? It does. Then if the client situation is such that it looks like he'll not be able to return to work and it's an extended illness, then maybe the strategic allocation also needs to change. On the other hand, if the client gets better and then life comes back to normal, then you get back to your strategic asset allocation. That's one scenario where you might deviate from the strategic allocation. The other has to do with short-term capital market expectations. If you are extremely bearish on the stock market because you believe it's currently overvalued, might you change from 90% to a lower percent in stocks? The answer is yes. And when you do that, this is referred to as tactical asset allocation. Because of your view on the market, you temporarily change the allocation, but in the long run, you will come back to the strategic allocation unless there is some other fundamental change in the markets or in the circumstances of your client. All right, now notice that we talked about constructing After constructing, we get into feedback phase where two things are happening: monitor and rebalance, and then evaluate performance. So before I go into the details of monitor and rebalance, notice this feedback step. If you think about it, let's say that you have a strategic asset allocation which is 60% stocks and 20% bonds. And over a given year, stocks do extremely well. What will happen to the weightage of stocks in the portfolio? Obviously, the weightage will go up maybe from 60-40 to 80-20. Is there a need to rebalance? If you want to stay with the strategic allocation of 60-40, then there is a need to rebalance. So that is one aspect of the feedback. The other aspect of the feedback is just monitoring the client situation and monitoring the capital market situation and making adjustments accordingly. But let's look at this in more detail now. Portfolio monitoring and rebalancing use feedback to manage ongoing exposures to available investment opportunities in order to continually satisfy the client's current objectives and constraints. And I've already talked about this, but we have two types of factors which need to be monitored: investor-related factors such as investor circumstances, economic and market input factors. So I've talked about this, so we will move on. Another aspect of this final phase of feedback is performance evaluation. And at this stage, I will just say a few basic things about performance evaluation, because this is also something that is covered in a lot more detail at level 3. Here at level 1, just remember these terms. The elements of performance evaluation are: number 1, performance measurement; 2, attribution; and 3, appraisal. Performance measurement is the calculation of portfolio rates of return. Now, this is just a one-liner, but there is a whole lot more to this. For example, at level 3, there is an entire study section on GIPS which talks about how do you do performance measurement. Then performance attribution is the analysis of those rates of return to determine the factors that explain how the return was achieved. To some extent, we have covered this in the very first reading on portfolio management, where we talked about active portfolio management, and we talked about whether the return is coming because of selecting particular stocks or because of taking particular exposures to particular risk factors and so on. But attribution is saying where is our return coming from. And then performance appraisal assesses how well the portfolio manager performed on a risk-adjusted basis, whether absolute or relative to a benchmark. So if a given portfolio manager is being assessed relative to the S&P 500, then at the end of every quarter or the end of every year, you look at the return and see whether the manager is indeed doing well or not. We now come to section 6, which is the other important section in this reading: investment objectives and constraints. When we talk about investment objectives, there are two core objectives: risk objectives and return objectives. And these are interdependent. You cannot just come up with a return objective in isolation without knowing the risk objectives. And specifically, we often talk about risk objectives first, because risk objectives limit how high the investor can set the return objective. Clearly, if the investor is very risk averse, then the return objective needs to reflect the level of risk averseness. To determine the risk objective, there are several steps. The first is to specify a risk measure such as standard deviation. So you might say that with our portfolio, the risk measure is the standard deviation of the portfolio. You might say that the risk measure is something called value at risk, which we just refer to at level 2. At level 3, we go into the details of value at risk. Our risk objectives might be absolute or relative. Absolute in the sense that we might say that our standard deviation or our volatility must be below this number. Or we might say that our volatility should be within a certain band of the volatility of a particular benchmark. So keep that in mind. Then we need to determine the investor's willingness to take risk. As we've seen at level 1, this is somewhat psychological. some investors will by nature be more risk-taking, others will be more cautious, and there are ways of doing some psychological tests to figure this out, but we don't need to go into those details. Just recognize that we need to determine the investor's willingness to take risk. Then we determine the investor's ability to take risk, and this is a little more objective. How can we do this, and what do we look at? You can think of the investor's spending needs, the planning horizon, whether that's long-term or short-term. If the planning horizon is long, what will that do all else equal to the ability to take risk? The ability to take risk will be higher. What about the financial strength? So if the investor is wealthy, then the ability to take risk will be relatively high. So you look at these factors and determine the investor's ability to take risk. And then you synthesize or combine the willingness and ability into the investor's risk tolerance. Generally, the risk tolerance will be expressed as above average, below average. So you can look at this 2x2 matrix where you have ability to take risk on the horizontal axis and willingness to take risk on the vertical axis. If the willingness to take risk is below average and the ability to take risk is below average, then what is the overall risk tolerance? Clearly it will be below average. What if the ability is above average and the willingness is also above average? Then the risk tolerance is above average. And these two areas, the curriculum says that they require resolution. So you might have to explain to the client that what should be overriding is the ability to take risk. That should override the willingness. Don't need to get into too much detail, but hopefully you are seeing a larger point that very often when you speak to a client and you define the IPS, you specify risk tolerance as either above average, below average, or average. And then based on this exercise, you specify an objective using the measure in the first step. So what does this mean? Here you actually put a number. In step 1, you said that this is my metric. For example, in step 1, you might say that the volatility of this portfolio is measured in terms of the standard deviation. So you are saying it's an absolute measure and the measure is standard deviation. Then at the end, you have to say that, okay, the standard deviation should be less than 10%, less than a certain number. So where is this 10% coming from? It's coming from this whole analysis. If you've arrived at the fact that the risk tolerance is below average, then that would mean having a small number. If the risk tolerance is above average, then you might have a much larger number over here. Coming now to return objectives. Here again, there are several steps. The first thing we need to do is specify a return measure such as a total nominal return. So as we did before, at this stage, we are just specifying the measure. We are not giving a number to that measure. So our measure might be our nominal return must be greater than X. The X will come later. Or we might talk about a real return, which is an inflation adjusted return. Or we might have a return relative to a benchmark where we will say that we need to have a return greater than so and so benchmark. Then we determine the investor's stated return desire. You need to understand what your investor wants. So the investor might say that I want a return of greater than 12%. We then determine the investor's required rate of return. And this connects with material that you've seen at level 1 quant, where you are given, for example, that the investor currently has 1 million. The investor will retire after 10 years. And at the end of 10 years, to support retirement, the investor will need 2 million. And let's say that over this period, the investor will have certain liquidity requirements and needs to withdraw 10,000 every year. Given these numbers, what is the required return on an annualized basis? Now, I'm not going to do the calculation for you because this is straightforward level 1 calculation. This is your starting point. and then you need to make these payments every year, 10,000, 10,000, 10,000, and then how much you need at the end is like the final payment. And you figure out what is the return necessary to achieve the objective of having 2 million at the end of 10 years. That will be the required rate of return. So how do you come up with the rate of return that goes in the IPS? If you think about it, you need to consider what the investor wants. You need to consider what the required rate of return is and the investor's risk tolerance. You combine all these and come up with a reasonable number for the risk objective. And obviously, the risk objective must, when I say reasonable, what I'm saying is you must also consider the capital market conditions and the capital market expectations. This is an excerpt from the curriculum that talks about return and risk tolerances for various kinds of investors. It is fairly self-explanatory. We are dealing with individual investors or pension funds, defined benefit plans, defined contribution plans, and so on. Now, each of these types of investors will have different return requirements and different risk tolerances. So I want you to go through this and make sure you read and understand what's stated here. This is material that you've already seen at level 1. Coming now to constraints, and the first thing is to remember these 5 standard constraints that need to go into your IPS. And the way I remember this is saying LLTTU. So liquidity, legal and regulatory, time horizon, tax concerns, and unique circumstances. Let's talk about these in a little more detail. The first 2 are the most important and most testable, liquidity requirements and time horizon. A liquidity requirement is a need for cash in excess of the contribution rate or the saving rate at a specified point in time. Now, here is an important point. This need may be either anticipated or unanticipated. The classic example that keeps coming up in the curriculum is that Mr. and Mrs. Smith have a son who is going to college after 3 years, and they will need to fund their son's college education over a 4-year period. So this is a classic example of an anticipated liquidity need. You might have another scenario where Mr. and Mrs. Smith are somewhat old and they do not have health insurance. So there is a chance that they will get sick and they will need money. So that is unanticipated liquidity requirement. If you look at institutional investors, then insurance companies will generally have high liquidity requirements, and those might be unanticipated in the sense that they do not know when the claims will come in or how much those claims will be. A time horizon is the time period associated with an investment objective. Investment objectives and associated time horizons may be short-term, long-term, or a combination of the two. A multi-stage horizon is a combination of shorter-term and longer-term horizons. A time horizon can be considered a constraint because shorter time horizons generally lower risk tolerance and hence constrain portfolio choice, making it more conservative. This is fairly straightforward. If your time horizon is only 3 months, then does it make sense to put money in the stock market? It does not, because the stock markets can easily crash over a 3-month period. So if you know that you need money after a short time period, then that constrains you in the sense that you will generally make more conservative or safer investments. Those who have longer time horizons can then make riskier investments, such as investing in the stock market, because we know that the stock market will be up and down, but in the long run, the stock market will outperform most other asset classes. These 3 constraints can be read by you. They are fairly straightforward. Obviously, you need to consider taxes when you do your asset allocation. And this is particularly true in scenarios where, let's say, the tax rate is different on capital gains versus dividends. That clearly will have an impact on where you invest. Also, you might have investors in high tax brackets. For those sorts of investors, it might make sense to invest in tax exempt securities such as municipal bonds. Other investors might be in low tax brackets. So you as a portfolio management need to understand the tax circumstances when you make investment recommendations. Obviously, there will be some legal and regulatory factors that you are concerned about. These generally apply to certain types of institutional investors. In some countries, there are constraints on where banks can invest, there are constraints on where pension funds can invest, and so on. You as an investment advisor need to know those constraints. And then unique circumstances refer to any factors that are not already mentioned. And the example given here is if an investor wants to avoid tobacco companies, that's perfectly all right. It needs to be mentioned under unique circumstances, and then obviously the portfolio should not include any tobacco companies. We now come to the final section, ethical responsibilities of portfolio managers. The key point here is that the portfolio manager is in a position of trust, and that is a major reason why he or she is required to act ethically. In fact, one should always act ethically, but it becomes a lot more significant when you are in a position of trust. So you can read this. This is another plug for the CFA Institute Code and Standards. So this connects back with the earlier readings on ethics. All right, let's quickly summarize. Broadly speaking, we have covered two areas in this reading. One is the process. So you need to understand the process and the link between different aspects of the process. In planning, you define the objectives, both the risk and return plus the constraints. You come up with an IPS. You consider capital market expectations, and collectively then you create the strategic asset allocation. The strategic asset allocation then feeds into the execution phase. In the execution phase, you identify the stocks or the assets to buy, and you instruct the trading desk to actually buy them. We then monitor the portfolio, which involves we then monitor both the client circumstances and the markets. And based on that feedback, you will need to make adjustments. We evaluate the portfolio performance. So that involves calculating the returns, doing performance attribution. So if we are getting a high return, where is it coming from? If we are getting a low return, what can that low return be attributed to? And then also we evaluate the performance of the portfolio manager based on returns. Then in the second segment, which was section 6, we talked about risk and return objectives. So you need to know how to define risk objectives, how to define return objectives, and you need to understand all 5 constraints. So that is it for this reading. As always, go over the learning objectives. They are not that many. We don't have any examples in this reading, but we have several good practice problems. So make sure you do all of them. And you will notice that many of these practice problems connect with other parts, because this is the final reading in portfolio management and it's the final reading in your course. You will see questions that seem to be straight out of level 1 quant, because that is needed, that knowledge is needed to come up with your return objectives. If you have time, then also do practice problems from other sources. That is it.